Hello and welcome to another edition of Real Day Trading. This is tons of fun, isn't it? It seems every single time, look here, the market is primed to go back up. A news story drops. So this is right here where you'd normally see a bounce. The market's coming down and it breaks through support here, comes back up, consolidates. Right here is where you get your bounce. And you could see other stocks starting to gain strength. Apple was gaining strength. Even Nvidia was gaining strength. It's hard to bounce without the tech sector, right? And then there's another news story. Pauses, and there's another one. And they just keep on coming. Now, suddenly, and after hours, we start seeing the market bounce back up again. Well, obviously for our account, which is in, not gonna lie, not in great shape right now. We're at 1400. We are going to need a significant jump in SPY. Probably on the order of going to have to see 446 tomorrow, somewhere around there. Not impossible. It can happen. Not likely, but it can happen. Uh, some sort of announcement of diplomatic talks occurring, anything like that, which is a terrible thing to base your account on, by the way. You know, my trading account is based on whether or not they're going to have diplomatic talks regarding the Ukraine is not a consistently profitable strategy. Still, it's what we got right now. Seems I might have to turn this from a 5K to a 10K challenge, unless it can go from a 1400 to a 10K challenge, to a 5K to a 20K challenge. But right now, we'll deal with what's in front of us, and what's in front of us is a whole bunch of crap. We have a short on Citibank. It's doing well. Citigroup, sorry. That short's doing well. The problem the problem for today, the mistake I made, if I would have just closed AMD first thing and recognized the bearish momentum in the market and left on Microsoft, then those Microsoft puts would have doubled from where I sold them. And AMD, while we would have lost, we would not have lost nearly as much. Count would be somewhere around 3,400, 3,500 if I did that switch. So that was a mistake on my part, closing Microsoft too early and keeping AMD. Now AMD, take a look here, you'll see. Let's go to here. AMD. And let's bring it over to the 5 minutes here. AMD here. Okay. And let's additionally put SPY on it. So look at what AMD does. Every single time SPY bumps up, AMD reacts dramatically. We have a huge increase. And in fact, I can go over here to Thinkorswim, and I can go charts, AMD, and let's put this on the, we need intraday. I'm gonna need 5 minutes. Okay. here, you can see here, this green, this is relative strength. Look how strong AMD is. Almost even when it's dropping, not dropping nearly as much as the market. So AMD had all this strength today, but it could not get the market behind it. In fact, at one point, AMD, you're looking at AMD here, it's pretty much right around $18 this morning. Well, actually, yeah, right around here. $17 this morning. Show you, sorry, it's right there. And there's AMD this morning, $17. So there's SPY. Every time SPY's bumping up, AMD, there's a little bump, bam, there it goes. So all we needed was for SPY to rebound off the 440 like it's supposed to, and we would be somewhere around 116, 117 in decent shape for tomorrow. Again, that didn't happen. So a combination of mistakes, news stories, but these are the things that happen when you're trading. This is what happens, right? I even was red in my regular account today, which is a rarity because day trading that, right? But you can have these type of days. It's part of what makes trading difficult because you can have days that you'll make mistakes. That's one thing. Or things completely out of your control. So there's, a lot more that goes into it than just knowing the indicators and the charts and so on, obviously. So where do we go from here? Well, we're kind of at the mercy of the market. Like I said, not a great place to be, not where I'd love to be, but where we are. And in the meantime, while we wait for the market to decide what the hell it wants to do, or more to the point, wait for Russia to decide what the hell it wants to do. And again, we have no idea if the market's already priced in an invasion or hasn't. I'm guessing it hasn't, but it priced in some of it. But there's no way of knowing that. So while we await that, let's take a closer look at options today. Here is an option chain. If you don't know what this is, and you're trading options right now, that's a problem. You have a problem. But if you know what this is, and you know what these Greeks are, you're way ahead of the game because a lot of people who are trading options have no clue. But I'm going to give you a little bit of a tutorial here on spreads. So hopefully you have a base knowledge and you can keep up with that. We're going to start with the typical call debit spread. So call debit spread is when you are buying a call right here. So let's say the 112, use AMD here, right? Okay, I'm going to buy that. And you are selling a call at a higher strike. So let's say we're doing the 115 here. Okay. There's $3 between these strikes, 112, 115. That means if AMD finished at, I don't know, 120, the 112s technically on Friday at end of day would be worth $8. The 115s would be worth minus $5 because you sold them. So you'd have $8 here, minus $5 here, total profit $3, right? But this will cost you $1.33 to buy this spread. So your total potential profit here is $1.67. $3 total profit minus the $1.33 you're spending equals $1.67. You want, when doing spreads that are at the money, and by at the money, I mean at the current price right here, right? You want the debit to be less than half the difference in the spread. So here we have a $3 difference, so you'd want this debit to be less than $1.50. The lower the better, but you don't want to pay more than $1.50. The idea being you're at the money, which means you at a base level are in a 50-50 position here. So you want the advantage of at least getting more than 50% in potential profit than you're paying. Put debit spreads work the same exact way, right? You're going to buy a put here and you're going to sell a put there. Great. At the money spreads like this, work with the same week expiration. Why is that? Because if I were to go and do this spread, for March 4th and say, okay, 112, 115, one, I'm going to pay more on the premium. Well, let's just say I can get it where I'm paying less than 50%. But even if AMD went up to 120, this spread would not be at $3 credit because the difference between the two, between the 112 and the 115, would not yet be exactly at $3 because there's still a ton of premium in there. There's a ton of time decay and IV in there, and there's going to be different levels for each one. So your 115 call is going to be loaded up with maybe more theta, and your 112 call might be loaded up with more IV. That is going to make it so the real difference between the two is going to be hard for you to capitalize on until you get closer to expiration. A lot of these type of plays, butterflies, are like this. Their value doesn't really materialize until you're close to expiration. Butterflies value do not materialize until you're pretty much at expiration. And I'll give you an example here of a butterfly. So let's say Amazon's always a fun one, right? And Amazon's dropping. Okay. Right now it's around 30, 95, somewhere in there. Let's say you think tomorrow it's going to keep dropping, going to fall off a damn cliff, and it'll reach 30.25 tomorrow. It's going to drop down another $70, right? Okay. So if you sold two 30.25 puts, and then you bought a 30.50 put, and you bought a 3,000 put, that's only going to cost you, but $1.55, $155 for one contract. If Amazon finishes tomorrow at 3,025, let's say right on the dot, finishes there, well, your 3,000 puts are going to be worth what? Zero, worthless. Your 3,025 puts are going to be worth what? Well, if you finish at 30.25, it'll be worth nothing. Preferably, you'd finish at 30.25 and 1 cent, so no assignment there, right? But your 30.50 puts are going to be worth $25. Okay, well, $25 minus the $1.55 you paid for this, right, is going to be $23.45. So $2,345 potential profit against the risk of $155. Now, if you finished at 30.35, this would be worth $15. These would be worthless. $1,500 profit versus $155 risk. The closer you are anywhere in between here of 30.25, 30.15 up to 30.45, this range here is your max profit on a butterfly. Now, I like to bracket butterflies when there is a lot of volatility and you don't know what's going to happen. In fact, if I didn't have a million other things, I would have done this in my regular account. Bracketed butterfly right here on Amazon at 30.50, 30.25, 3,000. And then bracketed, would have been $1.55, right? And then on the other end of it, here, if we did let's see here, we went down 75. So here, if we go up 75 and did a 31.75, 3,200, 31.50, that's $2.28. Now, again, you're getting 2,500, your max profit, and you're risking $228. So that is 2,500. That is $2,272, which is a pretty good risk return. If you combine these brackets together, you're paying $3.83 combined, so $383 for both butterflies. And if it goes up 75 or down 75, you're going to make somewhere on the order of 12 or 13 to 1, 10 to 12 to 1 on your money. On stocks like Amazon and Google, in a volatile market where it can go in either direction, bracketed butterflies tend to be profitable because one side typically will profit. I've had the occasion where I put them on Monday, and on Wednesday the put side profited, and then the market shot up, and then the call side profited, and you profit on both. That's more rare, but it can happen, particularly in markets like this. So that would be butterflies. Easiest way to calculate it is if you're doing a call butterfly, what would each option be worth if you hit the center target? The 31.50s would be worth $25. The 31.75 zero, the 3200 zero, you get $25, or which $2,500 for each contract, right? The idea behind it here is because you're selling two of the middle, right? So I'm getting, let's say, $7, $3.50 each, getting $7 in credit for selling the 31.75s. I'm paying around $7.75 for the 31.50s, and I'm paying the 3200s. I'm paying about $1.55 here, right? So $1.55, $7.75. So I'm paying around $9.30, and I am getting $7 in credit. So that's why the whole thing only costs $2.28. So you're paying for the two long calls, or in the case of bearish, long puts, for the credit you get for selling the middle call or put. That's the concept behind it. If you were doing a put debit spread, you would sell the 30.50s, let's say, and buy the 30.40s. You're going to get $2.30 credit here for a $10 spread. That's not much. Why? Because in this case, when you get a credit, you're risking the remainder of the difference. So here I'm risking $7.70, and I'm only getting $2.30 credit. Why would anyone do that? because what this says is Amazon would have to fall below 30.50 for this trade to start losing profit. And since there's only 1 day left for that to happen, if it is bullish or it stays the same or only slightly bearish, I mean, they can actually go down $50 and you could still collect your $230 credit. But like I said, if it drops more than that, then you're on the hook for 7.7. So high probability, but high risk, right? That's a different type of trade. Another type of trade you can make with options. Go back to our friend. Let's go to a company that announced earnings tonight. Like let's see, I think DKNG did maybe. No, they announced earnings tomorrow. Okay, so let's say DKNG. Okay, look at this volatility here. 326% IV. Next week's volatility, 138%, far lower, right? So look, if you did this, let's say you sold the 22 calls and then you bought next week the 22 calls. That's going to cost you 37 cents. Well, if DKNG goes up, goes down, we know one thing will happen. There'll be an IV crush. So this 326% here will get crushed down to probably 90%, somewhere around there. Why? Because all the mystery is gone. Earnings are out. And when that happens, the price of the option is going to go down with it. Now, obviously, if DKNG goes up, the price of the option will go up with it, but it's going to be weighed down by the IV. The beauty of this play is, even though, if let's say DKNG goes up $3, right? So this 22 option becomes worth $3.50. So now you owe $3.50 here. But your call over here is also going to go up. So that'll cancel each other out. What you will get, though, is this volatility is going to go down far more than this volatility will. Why? Because this is at 138 and this is at 327. So this can get crushed down by almost 70% here. This one will not get crushed by almost 70%. And because of that, the difference between that IV crush, you pick up that difference. And if you did something like this for 37 cents, you could turn around and sell it. You put a target in for, 55 cents or 57 cents, and you make a 40% profit or 30% return, somewhere in there, which is not a bad return. And that's called the time spread. And those are good ways to play earnings. What you're really playing is the IV crush or hitting your option that you'll owe on more than the option that you have credit on, and the option that you can get paid for. So the less the move outside what's expected, the better your credit will be. So DKNG obviously here has an expected move of somewhere around $3.50 to $4. As long as it's within that. If it goes up $8 or $9, then that's when it really won't matter. There's not going to be any difference between the options. You're not going to get much of a credit. But so you want to look for stocks that typically do not exceed their expected move. That's what you're kind of looking for here. Okay, well, those are some spreads for you. And the state of our SAD account tomorrow will be interesting to see. Right now, the market is currently up a bit. Of course, it is. And tomorrow, who the hell knows? And at this point, if you are just depressed or bored, or you know what, you just want to cuddle up by the fireplace and read something good, you know what you can do, right? You can watch some more videos and read the damn wiki. Good night, all.